Founders Forum, Episode 9.
Open your mind to a new episode of the Founders Forum, the podcast championing a free economy, sound assets, and blockchain solutions. Each week, your hosts, entrepreneur Cole Snell and economist Bob Murphy, interview pioneers and free thinkers to help you develop into the architect of your future.
Hey, everybody. Welcome back to another episode of the Founders Forum. Today, Cole and I are going to be speaking with Joshua Hendrickson, who's the chair of the economics department at the University of Mississippi, or Ole Miss. Let me just read a little bit about Josh's formal credentials, and then I'll explain a little bit about what our conversation entailed. So Josh has his PhD in economics from Wayne State University, which he got in 2010. His bio at Ole Miss's website says, Dr. Joshua Hendrickson's research interests are at the intersection of monetary economics, public finance, political economy, and historical economic development. Within monetary economics, he studies everything from historical monetary institutions to modern monetary policy to Bitcoin. Within political economy, he has used the tools of economics to understand revolutions, the decision to go to war, and how the national defense motive shapes the state and its policies and institutions. Finally, he examines the role of institutions in shaping the progress or regress of the state and the economy. So when Cole and I talked with Josh, the SVB failure, Signature Bank as well, we're still hot in the news, the Fed's bailout. And so since Josh has an expertise in money and banking from sort of an academic perspective or approach, so we asked him to comment on those matters. And then also, he happens to also be an expert in Bitcoin. And so later on in the episode, we were asking for some alternatives, like what can business owners do? Can, they use blockchain technology, for example, and Josh did favor that, at least for those who are technologically savvy. So it's a very interesting discussion. What Josh also brings up is something that you hear some economists talk about a lot, but I haven't seen it percolate too much into the mainstream discussion, is this idea of what's called multiple liability for bank creditors. All right, so the idea is if you're a shareholder in a bank right now, you buy stock in Citigroup or something, the most you can lose, regardless of how poorly the company is run, and even if they do really irresponsible things with their depositors' money, the most you as a shareholder can lose is however much you paid for the stock. But with this notion of, for example, double liability, then you could be on the hook for twice what you originally put in, that sort of thing. All right, so that's an idea that Josh brings up. Again, with all of this stuff, we're just trying to figure out how do we prevent recurrences of what just happened with SVB, because this is obviously a situation or a problem that keeps plaguing the banking industry in the West. So without further ado, here is our discussion with Joshua Hendrickson. Well, Josh, welcome to the Founders Forum.
Thank you for having me.
I know Cole and I are excited to talk to an academic and get your perspective on these weighty matters. So I think right out of the chute, why don't we start with just your take as to, if you had to explain it to a layperson, what was the problem with SVB? I guess to hit the issue of, was it just that the people running that bank did something foolish, or is there more like a systemic problem that, bodes ill for the future of banking?
Well, I think on the one hand, it's kind of something that happens from time to time with fractional reserve banks. But I also think that it's something a little bit unique to SVB.
Okay, so you give the classic economist answer on the one hand, and then on the other hand. So can you elaborate? So what was it specific? Like, what did the people running SVB do in particular that, perhaps why did they go down as opposed to some other bank?
Yeah, so I think it's kind of if you think about a fractional reserve bank, they are essentially like a coalition of depositors. So if I'm a saver, I've got two potential issues, right? So number one, I might not have enough savings to kind of diversify. And then number two, if I'm saving, I might need liquidity. So I might need access to cash right away. And so if you think about what a bank does, kind of takes all the money of depositors, sets some aside in reserve, and then it takes the assets and it kind of diversifies them across a variety of different kind of lending, like bonds and loans and things like that. But banks also give you this unique ability that you can come and redeem your deposit whenever you want. And so for this to work out well, what you want the bank to do is you want the bank to actually diversify the assets. But an underappreciated aspect of this is you also want diversification among your depositors. So you don't want your depositors all in similar type businesses or similar type industries, because if that happens, then they might all want liquidity at the same time. And so if they all want liquidity at the same time, they might all show up at the bank, and the bank doesn't have enough reserves to meet all of this demand. And so they're forced to sell assets. And typically, if they're forced to sell assets in a hurry, they're going to sell them below what they're valued at on their balance sheet. And that's going to reduce the asset values of the bank. And that can potentially push them towards insolvency.
Okay, so unspoken but implicit there is that SVP had depositors that were all, or many of them were from like the same industry, and is that why they were particularly vulnerable?
Yeah, so with the recent banks, like with Silvergate, with Silicon Valley Bank, they had a very concentrated customer base. And so with those concentrated customer bases, with Signature and with Silvergate, like those banks they had a lot of customers who were involved in crypto and things like that. And then with Silicon Valley Bank, they had some customers that were involved in crypto, but also just, normal kind of tech stuff. And so essentially what happened is that those types of firms have had a big increase in the demand for their liquidity. And so, they all have been drawing down on their deposit balances, and it's been forcing these banks to sell their assets, and they're being forced to sell them at a lower price than what they paid for them. Now, the reason I said that this is partially their fault is not just because they don't have a diversified customer base, but also because what they did is they invested a lot in U.S. Treasuries, and they invested a lot in U.S. Treasuries when the yields on those Treasuries were low. And so what we've seen is the Fed has been very aggressive with monetary policy and to try to rein in inflation. And so yields on bonds have gone up dramatically. And for those yields on those bonds to go up dramatically, the price has to fall, right? That's what generates that higher yield, is a lower price. And so these banks essentially were sitting on all of these bonds. And if they could have just held them to maturity, it would have been fine, even though they would have got a low rate of return. But they essentially had a lot of unrealized losses. And when these firms came and wanted their money back, they had to realize those losses. And so that was pushing them towards insolvency.
Okay, so yeah, just a bit of context for the listener. Like the banking system, I think, has over like $600 billion of unrealized losses on treasuries right now. So like you're saying, just this wasn't something unique to Silicon Valley Bank, but they were forced to realize the losses on their portfolio because their customers were concentrated in an area, like you say, where they needed to make withdrawals.
Yeah.
Cole, did you want to say something?
Yeah, just a quick side story. I managed a digital asset fund in 2021. And because of the fallout of the DeFi space, for the most part, or what kind of quote unquote crypto in 2022, I decided to kind of liquidate all my positions in the fund, close the fund, give everyone back, their money. The treasury for our fund was Signature Bank. So it seemed like the entire space was cursed in a way. So luckily, because of the demise of the DeFi world in 2022, it feared me. And I didn't fear Signature Bank failing at that point. I didn't feel like I was going to lose there. I felt DeFi. And so luckily, I got my money out of Signature Bank and managed to get it back to my investors. But it was a strange set of circumstances that had to happen, negative circumstances for me to do that. But I felt like I got kind of lucky. One of the things that you were saying, Josh, that I really appreciated was, say, with like Silicon Valley Bank, they are very focused on, say, funding the tech industry. Because of the niche and the fallout of tech, and outside of what you were saying about bonds, there was obviously, kind of a bit of a perfect storm happening there. So with Lehman Brothers, for example, in 2009, I think it was, technically, would it be a similar circumstance in the sense like Silicon Valley Bank was focused on tech startups? Because of the subprime mortgage crisis, was Lehman Brothers focused on mortgages?
Yeah, so typically when we see banking problems, it looks more like Lehman Brothers. It's typically like there's something wrong with the asset side of the balance sheet. And then that's why people are coming to the bank. And so the issue with Silicon Valley Bank is that the tech industry is incredibly sensitive to interest rates. And that's because they're spending a lot of money now in the hopes of generating profits in the future. And so if interest rates are really low, people are much more willing to invest in those companies because the present value of those profits are higher, or potential profits are higher. And the rising rates kind of triggered both things. So essentially what happened is the higher interest rates made it much harder for tech companies to raise money. And so they had to rely on their deposits for cash. And then at the same time, a lot of their assets were in these government bonds, and the yields on those bonds and the price were going up and the prices were going down. And so it was kind of this perfect storm in the sense that all of their depositors started to need the cash in the bank more because they couldn't rely on just raising funds from, say, venture capitalists or something like that. But then also at the same time, their assets were falling in value at the exact same time that these customers had an increase in the demand for their cash.
So Josh, in response, as people know, the authorities came in and the Fed, among other things, sets up this new facility. Can you just talk a little bit about, specifically what they're doing? And also, I'm curious as to your thoughts, because I've seen arguments made on both sides about whether this constitutes a bailout, specifically them allowing banks to pledge treasuries and mortgage-backed securities and other agency debt at par, as opposed to like what the current market price would be if they had to sell it. And then, is that a bailout? Does that put taxpayers at risk? Those types of things. I'm just curious what your thoughts on those are.
Yeah, so the basic idea behind what the Federal Reserve is doing is they're giving these banks access to this lending facility. And so what that allows them to do is that they can borrow money from the Fed using these treasuries as collateral, but they don't have to mark the treasuries to market. So if you bought, a treasury for $100 and now it's worth, 90 or something like that, and you want to borrow, even though if you were to sell that bond in the market, you would get $90, they're going to let you borrow $100 against that bond. And the basic idea is that, well, if you were to hold it to maturity, then you would get your money back at the end. And so the idea is that they're kind of just letting these banks act as though their bonds are still trading at par. So in some sense, they're kind of giving banks put options on their bonds with the strike price equal to the price that they paid for it, right? Because conceivably, you could post this collateral, you could borrow the money against it, and then if you don't pay the Fed back, they just take your collateral. Well, if they take your collateral, the Fed is losing, right? Because the market value of those bonds is less than what they lent you. And so in terms of the bailout, I think there's a couple aspects to this. When people talk about the bailout, some of it is sort of like semantic, like what is a bailout? Like, does a bailout require taxpayer funding? Or what if what if the bailout is financed by the Federal Reserve? Does that actually constitute a bailout? And then if it's financed by the Federal Reserve, then, it's possible that the Federal Reserve can generate income off of this, in which case they would have to turn over that income to the Treasury. And so in that case, the taxpayer not only wouldn't be paying for it, but actually it sort of paid for itself, right? But if they take losses, on the other hand, then the Fed is giving less money to the Treasury, and that means that more of the government spending is going to have to be financed with debt creation, in which case, future taxpayers are paying for it. But I actually think that a lot of the mechanisms about that are sort of missing the point. Like, the point when we think about bailouts is really sort of about what incentives does this create for banks? And is there moral hazard created, right? So are banks likely to be riskier because the Fed is doing these sorts of things? And a lot of the arguments that I've seen presented are like, well, there's not really any moral hazard because, the shareholders are all being wiped out and the executives are all being replaced. And so they're all being punished for the poor behavior. It's only the depositors that are sort of being saved here. But I'm not quite convinced by this argument because it effectively gives executives at the bank an incentive to just engage in risky behavior because it's a sort of heads I win, tails nobody loses scenario as far as they're concerned, right? So if I'm a bank executive and I'm making millions of dollars a year, I can take my assets and, I can go to Las Vegas and I can put all of my assets down on red and spin the roulette wheel. And if it comes up red, the bank is super profitable, everybody's happy and we're all excited. But if it comes up, black, then I lose all of that money. But hey, the FDIC and the Fed are just going to come in and pay back the depositors. Well, then if that's the case, then there's not really any downside to me doing that. Now I might lose my job, but if I'm making millions of dollars a year, conceivably I'm making less risky bets than a roulette wheel, right? But I could engage in riskier behavior than I otherwise would. And I don't have to worry that depositors are going to be harmed by this. And so if I can do this for some period of time and kind of get away with it until, one day the bets don't pay off, like why not try it, right? Because there's no penalty from the perspective of the executive. Like, yeah, you lose your job, but you were making millions of dollars and probably collecting bonuses along the way as those earlier bets pay off. And so it's not necessarily clear that the present discounted value of the super risky strategy is less than the present value of just being conservative and responsible. When you figure that they're just going to kind of bail out the depositors anyway, I don't have to feel bad, right?
Right. I'm curious, is there anything at all also, because I know some people who object to the plan, they'll also bring up the moral hazard, but they'll come at it from the point of view of the depositors and say, oh, exactly, it's making the deposit. So now, again, like the problem that some people have with FDIC period is the mass of the customers of banks don't care what the bank's doing with their money. And in general, wouldn't you want the depositors also, especially like if they're pretty savvy and, they're multi-million-dollar companies figuring out where to park their funds, don't you want them investigating the banks and what their behavior is as another check, instead of relying on government officials to make sure everything's above board or, the incentives facing the individual bank executives. If their customers realize, well, if the bank goes down, we're going to lose a bunch of our funds, so we should police them ourselves, that element gets taken away.
Yeah, so I think there's a couple aspects to this argument. So the important thing to note here is that one of the reasons that policymakers stepped in is that this, in the case of Silicon Valley Bank, deposits are only insured up to $250,000. And a lot of the depositors at Silicon Valley Bank, they had much more than $250,000 in their account. And one argument that I've seen people make is that, well, we can't expect depositors to be paying attention to their bank balance sheet or something like that. And so on the one hand, this is kind of a weird argument because first of all, like if you have less than $250,000, like you can make an argument that those people wouldn't actually have to pay any attention because they're insured. And so they'll get their deposits back no matter what happens to the bank. And so, yeah, those people, maybe they don't need to spend a lot of time thinking about the balance sheet of the bank. But if you've got more than $250,000 in a bank, I would think that you would want to be looking at what the bank is doing and making sure that this bank is responsible, since you could potentially lose all of that money in the event of a bank failure. So the idea that like somehow people who have enough money to be far beyond, the insurable amount at these banks, the idea that they can't monitor the banks, especially when most of these banks are publicly traded companies where, their balance sheets are on their website. It's not difficult to get them. They have to file these with the SEC, right? It's publicly available information. The idea that like you wouldn't even want to monitor this. And in the case of firms, like you could literally just have someone on your staff whose job it is to periodically just kind of go through and do some kind of risk assessment of the bank. The other point that I would mention is like this idea that like depositors just won't pay attention to banks is kind of ludicrous because it doesn't make sense in historical context. So prior to the 1930s in the United States and a lot of other Western countries, we had a system of multiple liability for banks. So the most popular version of this was double liability. But so under double liability, if I was a shareholder in, say, Bank of America, if I took $10,000 and bought Bank of America stock, if Bank of America went under, then naturally I would lose that $10,000. But the way double liability worked is that if Bank of America went under, then I would be responsible for an additional $10,000 out of my own personal wealth to make the depositors of that bank whole. And so what this does is it actually gives an incentive for shareholders to care about what happens to depositors since they're financially responsible for those depositors. And if you look at this era, what actually happened is like bank ads during the time of double liability, banking advertisements were not like beautiful women with their, hair blowing in the wind using an ATM. What they were really boring advertisements that were like, hey, here's the amount of equity capital we have in the bank. Here's the member of our board of directors. Here are all the members of our board of directors. Here's the manager of the bank. And so there was sort of reputational information there. There was financial information there. And so banks actually had the incentive to communicate to their depositors exactly what was on their balance sheet, because that's how you attracted depositors. Depositors didn't want to go to a risky bank because then they'd have to rely on a bankruptcy court to issue judgments against all the shareholders and collect the money and then distribute it to all the depositors.
Can you just clarify, Josh? I missed, when was double liability actually a thing?
So double liability existed up until the 1930s. So in the 1930s, when the United States government introduced deposit insurance, banks became limited liability companies.
Okay. I'm curious too, just to go back a second, for what the Fed is doing right now, and you were walking through some logistics of that, because I've seen defenders of the Fed's moves saying it doesn't matter, they're not going to lose money because, like you said, worst case scenario, some bank pledges collateral, that they paid 100 for. Right now, it's trading in the market at 90, whatever. The Fed lends them 100. Let's say they default on the bank defaults on the loan. So the Fed seizes the collateral that right now is trading at 90. So what? The Fed just holds it to maturity. They're not going to lose money. So I'm curious, if like a two-pronged question. One is, even if they did hold it to maturity, isn't there still something wrong economically with that? You can tell from my tone. I'm trying to lead the witness. But like, in other words, why don't they just do that in general then? Like forget banks, just in general, can't the Fed just magically make us 10% richer by pledging, by lending to people at above, the collateral value, if they could just hold the asset, whatever it is, a pickup truck or a piece of real estate. But also, could the Fed have painted itself into a corner? Like if it needed to tighten more aggressively than it currently anticipates, if it's now holding a bunch of treasuries that it needs to hold to maturity or else it loses money, could they also sort of be in a pickle?
Yeah. So typically, if the Fed wants to expand the money supply, what do? They go out and they buy bonds in the open market. But if they want to contract the money supply, they have to go out and they have to sell bonds in the market. And so we have been dealing with very high rates of inflation. And so the Fed has been engaged in quantitative tightening. So what that means is they're going out and they're selling these bonds to try to reduce the size of their balance sheet. And so if inflation is still, the CPI came out earlier this week, it's still 6%. And so 6%, the last time I checked, is greater than 2%, which is their target for the inflation, which means that their job isn't done on inflation. And so now they've put themselves in this very difficult position because now they're using this facility to try to prevent some kind of banking crisis from happening. But they're doing that at the same time that they are trying to bring down inflation. And so they're trying to engage in contractionary policy and at the same time lending a bunch of money to banks by, lending them more than what the value of those assets are. And so if they're borrowing those bonds and banks default on those loans, well, now they have those bonds, and as long as they hold them to maturity, that's fine. But if you're engaged in quantitative tightening, you might have to sell some of these bonds in order to try to bring down inflation, in which case the Fed is going to realize these losses.
As I'm sitting here listening to you guys, there's two questions that were coming up. So we had essentially crypto, let's just say FTX, fail epically not long ago. And people are just kind of pointing fingers at crypto and they're going, told you so. And then, a few months later, 2 months later or so, now we have like major banks that support the tech industry failing. How do you think Sam Bankman-Fried, Josh, how do you think Sam Bankman-Fried, sitting at his parents' house in Palo Alto, is feeling about this bank collapse? Like, if you were to get into his mind about this, how is he looking at this? Is he thinking, okay, my sentence isn't going to be as long now? The spotlight's off of me. What do you think he's thinking?
He might hope that that's true, but I don't think that's true at all. Partly because what he was engaged in wasn't just sort of bad management, it was fraud. I haven't seen any allegations that Silicon Valley Bank was engaged in fraud. Maybe they had poor risk management, but that's not fraudulent. I mean, one of the problems with FTX is they had a lot of quote unquote assets on their balance sheet that were not really valuable in the market, right? And so,
FTT.
to put it lightly, right?
FTT was, to put it that it wasn't valuable. Yeah, right.
Yeah. And so, and I think the other thing is actually, if you look and see what's going on, I don't think that this is going to change people's attitudes towards crypto, certainly not within the government. And I think that all the evidence that you need for this is that they shut down Signature Bank. And Signature Bank, as far as the news reports that have come out, Signature Bank did not seem to be, they were having similar problems, but they did not seem to be in as dire circumstances as Silicon Valley Bank or Silvergate or some of these other banks. But the government came in and they shut down Signature Bank and said, we're going to unwind this bank. And Barney Frank, who is, hardly the beacon of libertarianism or something like that, essentially said that, he felt like this was a government attack on crypto. And so I think if Barney Frank is saying that, then maybe we need to think a little bit more carefully about why they took over Signature Bank. And if Barney Frank is right, then this not only isn't going to distract people from Sam Bankman-Fried, it's actually just part of a broader crackdown.
Right. And so for the listeners, Signature Bank was like the first real big bank that if you had crypto and you wanted to wire money, and they got into the crypto industry, exchanging fiat, settling crypto, allowing onshore, offshore investments pass through into the United States. New York, primarily the branch in New York, was, famous for doing crypto deals. And so they were the first real big bank to kind of make crypto investment from an accredited investor mainstream.
Josh, it's ironic that you brought that up because I was literally just about to ask you about Dodd-Frank. And so I can imagine there's some people watching this unfold and thinking, okay, there was the real estate bubble, all the bailouts and everything happened in 2008. The Dodd-Frank legislation came in. They told us, we fixed the banking sector and this time we mean it. And now this stuff is all happening again. So, and again, not to be cynical, I'm genuinely asking you. It's not that I'm hoping you say one thing or the other. I'm just curious, is it that, humans are complicated. The economy's, is hard Barbie kind of thing. And it's, you fix one set of problems and then new ones come. Because obviously what SVP got into trouble for was not making dodgy housing loans. Like it was completely, like you said, treasuries are considered like the safest asset in the world. And it's like, they foolishly bought a bunch of treasuries. That sounds like a funny thing to say. And yet in a sense, that's partly what's going on here. So I'm just curious, is your take, is it that the three of us in this conversation are very skeptical in general of government intervention to fix things, but I'm just wondering your take, is it that they let the Dodd-Frank stuff completely miss the boat, or is it that, a new set of problems always arise?
I think it's that we just, throughout U.S. history, we've had terrible banking policy. Like banking policy has always been designed to fix some sort of problem or prevent some sort of problem. But there's not a lot of thinking about how this affects the incentives of the banks and of the depositors and of the shareholders. And so if you think about going from like that multiple liability system to limited liability with deposit insurance, right? Limited liability is essentially saying shareholders, you're no longer financially responsible for these depositors. And deposit insurance is saying shareholders, you're no longer morally responsible for these depositors, right? And so if you think about what that does to incentives, it gives greater incentives for risk taking. And when we think about a lot of these issues, regulators seem to think that they can just stop these things from happening by just coming up with better rules. And, one of the big things that legislators were talking about in the aftermath of the financial crisis was, we just need to have banks finance more of their operations with equity instead of debt, right? But then the solution is we created all of these risk-weighted capital ratios that were designed to, you have to hold this much equity based on, the type of asset that you're holding. Well, ironically, like treasuries, because they're considered, perfectly safe, we didn't even have to hold anything against the treasuries because, those are risk-free. And so it's one of these things where bank regulation in the United States just has a history of focusing on rules rather than incentives and not thinking about the incentives that their rules create, like the unintended side effects. And then also at the same time, they also seem to be fighting whatever the last battle was. And also the problem with just creating rigid rules is that when unexpected things come about, like the rules can't possibly anticipate the unexpected thing. So nobody predicted that there was going to be a pandemic and that the Fed would print a bunch of money during the pandemic, and then what this would cause inflation, and then they would raise interest rates, faster than they ever have before. No one predicted that 3 years ago, let alone when they were writing Dodd-Frank. And so there's always, circumstances that the regulators can't foresee and that the rule makers can't foresee. So they just kind of fight the last battle.
That's interesting. I hadn't even thought of that, like the Basel III and some of these other regulations that were put in place after the '08 crisis, ironically, made financial institutions have to carry more treasuries than they otherwise would have in the alternate universe where the regulations stayed the same. So now if we're wondering, well, gee, how come these institutions are foolishly sitting on so many treasuries? Well, partly because the government made them. So what's your, I guess, maybe to try to make it a little more practical we have a lot of listeners who are business owners, they tend to be interested in the, tech space. What, you're some business, you've got your payroll and one bank right now, like what do you, again, and you can say whatever caveat you want to not be, you're not rendering financial advice. I realize that, but just hypothetically, if you were writing a novel about this scenario, what would your characters do that you cared about? Like, what would they do? Because it's tricky right now. If like John Cochran had his proposal for a narrow bank and thing, but right now, what are you supposed to do if you're like a small to medium sized business owner and you're just looking around and you do not want to be in the position of a customer of SVB 3 months from now?
Well, I think number one, it kind of illustrates the importance of diversification, and that diversification is not just in regards to the investments of your company. It's also in regards to the banking relationships. So, you want to have a variety of banking relationships rather than just one bank. And the other thing is it illustrates the importance of, if you're operating a company, chances are you have a bank account that is over the deposit insurance limit. And if you're over the deposit insurance limit, you do have to pay attention to what's going on with these banks. And you do have to have an idea of what banks are doing with your money. And if you're doing things like that, then you can protect yourself, right? I mean, if you were somebody who had all of your deposits in Silicon Valley Bank, last weekend you were wondering, how in the world am I going to pay people, right? Because I can't even get my money. But if you have multiple bank relationships, yes, you would still have been concerned about your money at Silicon Valley Bank, but at least you would know, hey, I can still make payroll. I can still continue to operate my business, in the immediate term.
I really think that that's a really tangible point. And I think banking diversification, I really appreciate you saying that. Here's me sitting in a room with two doctors of economics, and here I am as the guy that's been thrown against the wall as a founder for 30 years trying to hope it sticks. Luckily, it has. I diversify my banking, but I didn't even realize it until you just kind of really pointed it out. I didn't even really think of it. It was more like intuitive to me that I keep more money now in life insurance than I have ever. I have relationships with 5 or 6 different banks, and I have pockets of money in each one. And it wasn't until probably right now that I really could say that I actually exercise bank diversification. You don't really think about bank diversification. You think of diversification. That's like financial literacy 101. That's investing 101. But banking doesn't really factor into that. I guess the follow-up question, I'd be curious, Josh, to hear you mentioned that this isn't doing anything for crypto positively, I don't think, and I tend to agree with you. Is it doing anything for blockchain? And in your mind, is there a solution from a blockchain perspective, technologically, that the founder could somehow, through maybe security tokens or other registered exchanges, hold assets? Can that be a component of banking diversification?
So if you want me to give you a really radical advice, I think that if you're a company that has, double digit growth and you're generating a lot of cash flows, one way you can diversify is you could follow the sort of micro strategy approach and you could buy some Bitcoin. Because if you need money, you can always sell the Bitcoins. And I mean, if you look at things, okay, full disclosure, I'm a senior fellow for the Bitcoin Policy Institute, so I should disclose that given that I'm talking about Bitcoin. But if you have a lot of free cash flow and you're concerned about these things, you can always buy Bitcoin and you can self-custody your Bitcoin. And now, if you're going to do that, I mean, conceivably, you would be doing that as a sort of long-term treasury, right? Like you wouldn't be doing that, in the short term. The idea is you would be doing this to hold it for a decade or something like that, right? But in case something like this happened and you had no money, I mean, it at least gives you sort of access. And I think that to some extent, I mean, it's impossible to reason from a price change, but I mean, but since Silicon Valley Bank got taken over, I think Bitcoin's price is up like 35%. And so, maybe it's coincidence, but the fact that it's 35% makes me think maybe not. The other thing I was going to mention, though, too, about bank diversification is it actually does make me kind of wonder if what you're going to see in banking is if people actually respond to this and they take this seriously. What it really makes me wonder is if what we're going to end up having is we're going to have like a lot of local banks where it's easy to have like a local banking relationship. You know your banker, you know what they're doing. They're very conservative. And then you have just these massive banks like Citi and JP Morgan and places like that, where you know that the government's going to save them no matter what. They're systemically important. And so you don't have to worry about your money there. And so I kind of wonder if the diversification is going to lead people to, well, I'm going to diversify. I'm going to keep it at like, my local Oxford bank. And then I'm also going to keep it at JP Morgan. And it's those regional banks in between that kind of suffer the consequences of that.
Right. And I don't think it's any coincidence at all that Bitcoin is up after the banks went down. And I think that fans of Bitcoin, I am one, have been looking for that. We've been looking for those kind of moves. Now, I think we need to see that happen a few times over to really kind of prove it out and kind of sing from the rooftops about the utility of Bitcoin, doing what we said it would do. But when we're thinking of banking to a founder in terms of banking diversification, I mean, I think it's just so important to think about banking as a warehouse of capital, as a quote unquote banking, as a safe place, ideally safe place to store your capital. And, what is your quote unquote bank? Your bank doesn't need to be a blue bank or a purple bank or a red bank, it just needs to be a place. And I think that blockchain, I said blockchain, you said Bitcoin. I think Bitcoin is the best use case for blockchain today. So then the question is, could Bitcoin be your bank, quote unquote bank, right? This is going to drive some people, think about bank charters. Again, this is not financial advice. I speak for all three of us right now, but quote unquote banking as in like a warehouse or a storage facility. I got a bank of something. When I was a kid, I loved candy when I was a kid, so I wanted to have a bank of candy. Businesses want to have a bank of money. Well, where do you put it? Bitcoin?
Yeah, just to push a little on that, Josh, I'm sure, I know you guys know this, I can just tell from your commentary, but also some of the listeners, in case they don't realize, what was interesting is that, Bitcoin fans, and again, I'm one also, I think when a few of these financial crises were hitting, going way back, since the foundation of Bitcoin, they expected that, on a day when there's carnage in the markets, we would expect Bitcoin to go up. But actually, that wasn't usually the case thus far. That, in general, again, speaking with a broad brush here, that if the markets were tanking, Bitcoin would be down also. And I would talk to people and they would say, well, it's because, you need liquidity. And so it proved that Bitcoin was a good store of value because when you need it, you sell and get the money when you need it kind of thing, when your stocks are getting crushed. But I kind of thought that was like, well, gee, which is it that no matter what happens, it proves how awesome Bitcoin is, whether it goes up or down. But so I'm wondering, Josh, like my take would be, and I'm wondering if you agree, the reason Bitcoin went way up after this particular thing is because this wasn't just a general, the markets are bad. It was the banking system is now in doubt. And that's what Bitcoin's whole, raison d'etre is. And so is that partly, as opposed to like, when COVID hit and things went down, that wasn't, you weren't worried about the financial system per se. And so there was no reason for Bitcoin to, so I'll stop there, but you get what I'm asking?
Yeah. But I think it's hard sort of knowing like what's driving the price. But I think like post-COVID, I think the price has been a little more in line with sort of like both the aggregate risk and the idiosyncratic risks. So what I mean is that in bad times, everything sells off because people need money, right? And so like you're holding savings for future consumption. And so all of a sudden, when you're losing your job or when things are much worse than you imagined, right? Like you sell your assets so that you can consume. And that tends to manifest itself like during COVID, it tends to manifest itself in like this massive drawdown in asset prices because people are all trying to do it first, right? And so the dramatic drawdown in something like Bitcoin, like in the early days of COVID, I don't think it's counter to what you would expect because people were very worried and, they needed immediate cash, or at least they thought they might need immediate cash. But also, when the Federal Reserve started announcing that they were going to do another round of quantitative easing, the price went up dramatically during that period. Now, some of this might have been driven by all the speculation in sort of crypto more generally. And so how much of that was due to Fed policy and how much of that was just due to the timing of that speculation, I don't know. But I mean, that was one interesting thing, I think, in the last week is that Bitcoiners say, oh, like this is an alternative, right? This is your lifeboat from the existing financial system. But the price, as you said, like doesn't always seem to follow with that claim. And so I think it was kind of interesting this week that it actually did. And so when all the news of these banks having trouble occurred, the price has sort of consistently risen throughout, the last week. So I mean, even after the announcement of the rescue, even after the announcement of this new Fed facility, the price continued to go up. And so maybe that's just coincidence, but I think the magnitude of that change suggests that at least some of that is due to people sort of realizing what the use case is.
It's so interesting. And I think it's important that we're still talking about this right now because prior to the three banks collapsing, there was systemic talking heads on social media, crypto experts saying, sell everything now. The US government is going to dump their Bitcoin reserves, the Mt. Gox, Bitcoin is coming back into the marketplace. So there was a lot of people, consistently the message was sell or, go into cash and buy back in later. And now we see this 35% spike in the face of bank collapse. Do you, Josh, feel as though that this is this something that people are missing? Is this a big deal? Is this you've obviously been following Bitcoin for a long time. Do you think this is a pivotal example of Bitcoin's utility?
Yeah, I mean, the basic idea is that it's kind of like a man-made commodity, but the sort of the idea that you can exchange it easily and that you can custody it yourself, I think is the important thing that it has going for it. But I would also point out that, a lot of the policies aimed at crypto, what they're doing is like one of the first academic papers that I wrote about Bitcoin was all about, effectively what happens if the government tried to just close all the on and off ramps from Bitcoin, like what would happen and that sort of thing. And so when we start thinking about that question, then it gets pretty complicated because this becomes like strategic behavior. We got to think sort of in terms of like game theory and things like that. But the question is, how do people respond to it? Because on the one hand, if they had done this kind of stuff in 2014, 2015, I don't think that it's hard to imagine that Bitcoin maybe never becomes what it is now, right? I mean, now you turn on CNBC and they've got the Bitcoin price in the right-hand corner all day long. And so, it's sort of part of the public consciousness now. And so that game theory becomes kind of interesting because, when there's not a lot of people who are really committed to it or who really just want to use Bitcoin, then shutting down the on and off ramps can very easily, lead to, its failure. But if you have a big enough group of people who are just like, look, I'm going to hold this and I don't care, I'll just figure out how to trade it with other people who want to trade it, even if you close, the on and off ramps. Well, then at that point, there's not much that they can do. Now, maybe they can prevent it from widespread adoption. But I do think that a lot of what's going on and a lot of what's going to happen is aimed at closing those on and off ramps. I think that sort of has become an implicit policy of the government.
There was a lot packed into that. I just wrote down man-made commodity. And I think in your last comments, you identified a lot of optimism and some skepticism. And, I know that you also talked about a big community and pooling a lot of people together. That's what we're trying to do on this podcast. We want to thank you for contributing to that. We're only 9 or 10 episodes into this thing, and we're already, because of people like you spending your time laying down a foundation, and a lot of the stuff that you and Dr. Murphy were talking about today are things that we want regular people, we want non-economists, non-PhDs to be able to understand a lot of this stuff. And I think we have an obligation to increase, call it financial literacy at this level. So again, on behalf of Dr. Murphy, I want to thank you, Dr. Hendrickson, for being here today and contributing to our cause.
Thank you for having me.
This concludes another episode of the Founders Forum. The information provided is for educational purposes and does not constitute financial advice. Consult with qualified professionals before making any financial or investment decisions. For more information on the hosts and for previous episodes, visit foundersforum.io. Thanks for listening.